Hello people! Welcome to the Fortune Fastlane YouTube channel. What is economic foundation? The total quantity of money that is either in the hands of the general people as legal tender or that is held in the reserves of the central bank as commercial bank deposits is known as monetary base or M0. Due to the fact that it does not include various non-currency types of money that are common in contemporary economies, this measure of the money supply is not frequently used. A country's money supply includes its monetary basis. It only applies to extremely liquid assets such as cash on hand, coins, and notes. If you want more of this content, Fortune Fastlaner, subscribe to the Fortune Fastlane YouTube channel and hit the notification bell. Even though it is not frequently referenced and is not the same as the money supply, the monetary base, MB or M0, is a crucial monetary aggregate. It includes the entire amount of money in use as well as a part of commercial bank reserves that is kept on hand at the central bank. Because it may amplify through the use of fractional reserve banking, this is frequently referred to as high-powered money or HPM. Demand deposits, traveler's checks, and other checkable deposits are included in M1. A more specific measurement of the money supply that also takes physical cash and reserves into account. Savings deposits, money market securities, mutual funds, and other time deposits are referred to as near money in the definition of M2, which also includes all components of M1 in its calculation of the money supply. These assets can be readily turned into cash or checking deposits, but they are less liquid than M1 and less suited as exchange mediums. M2, as well as significant time deposits, institutional money market funds, short-term repurchase agreements, and more liquid assets are included in M3. A measure of the money supply, however, as of 2006, the Federal Reserve no longer releases information in M3. For instance, country Z has 600 million currency units in circulation and 10 billion currency units in reserve, all of which came from deposits made by numerous commercial banks. In this instance, country Z's monetary base is 10.6 billion currency units. Beyond the monetary foundation, the money supply also encompasses possible less liquid assets. It is typically divided into levels, with each level representing a distinct aspect of a country's resources. These levels are designated as M0 through M3 or M4 depending on the system. The monies that make up the monetary base are often kept in the lower tiers of the money supply, such as M1 or M2, which include cash in circulation and particular liquid assets like savings and checking accounts, but are not limited to them. The money must be regarded as a complete settlement of a transaction in order to qualify. For instance, if someone pays a debt in cash, that transaction is done. In addition, if the transaction is supported by actual cash deposits, once they have cleared, writing a check against funds in a checking account or using a debit card can also be regarded as final. The utilization of credit, on the other hand, does not count as part of the monetary basis because it is not the last step in the transaction. This is because using credit only transfers an existing debt between the party receiving the credit-based payment and the credit issuer. One sovereign entity, typically a nation's central bank, is in charge of most monetary bases. Through open market transactions or monetary policy, they can often alter the monetary base by increasing or decreasing it. By purchasing and selling government bonds on the open market, the government of many nations can keep some degree of control over the monetary base. The total amount of bills and coins in the household, as well as any money in savings accounts, make up the monetary foundation at the household level. The amount of money in a household may be expanded to include any credit that is open on credit cards, any unused credit lines, and any other monies that can be used but result in a debt that needs to be returned. The quantity of money in circulation in the economy is referred to as the monetary basis. It is divided into two components: bank reserves and money in circulation. The public's possession of banknotes and coins, the money we use on a daily basis, is referred to as currency in circulation. Financial institutions keep bank reserves in their accounts, with the central bank as cash deposits. The most liquid assets in an economy are cash and cash deposits, which are represented by the two factors above. Overall, the monetary base gives an indication of how much cash is moving across the economy. The quantity of money in circulation in the economy is referred to as the monetary basis. The two components that make up the monetary basis are bank reserves and the money that is in circulation. The monetary base, which should not be confused with the money supply, exclude non-cash assets including demand deposits, time deposits, and checks. The central bank, which oversees the movement of money throughout the economy, typically measures the monetary base. The physical money in the economy, whether it is in your wallet or the bank vault, is often mistaken for the monetary foundation. The monetary basis may also be referred to as basic money, M0, or money supply. The monetary basis, in contrast to the money supply, only consists of money in circulation and bank cash reserves. In contrast, the word money supply refers to the total amount of money in a nation. Fewer liquid assets such as demands, deposits, cash in a checking account, time deposits like CD or GIC, or checks are included in the money supply. The assets won't be part of the monetary base but will be counted in the money supply. As a result, the money supply can be seen as a continuation of the monetary base. Through a variety of monetary policy measures, central banks can raise or decrease the monetary base. Many central banks expand their monetary basis by buying government bonds, a process known as open market operations. The central bank can replace the illiquid bonds with a cash deposit in the bank's reserve account by buying bonds from commercial banks. The amount of cash that banks are required to hold in reserve accounts, as determined by central banks, may also be increased. The amount of money on the market will rise, which will lower interest rates. As a result, one more instrument that central banks employ to alter interest rates is changing the monetary base. Central banks can also make certain that there is always a consistent amount of money available for usage by adopting monetary policy to maintain in the monetary base. Let's say that the made-up nation of Anko has coins and banknotes in circulation worth $250 million. Additionally, the commercial banks received $150 million in cash reserves kept in the central bank of Anko, as well as $100 million in cash stored in their safes. Anko's financial foundation would be $500 million in total. Let's say the central bank of Anko makes a decision to boost the monetary base by repurchasing some bonds issued by the government. The central bank deposits $50 million in cash into a bank's reserve account for every $50 million in bonds it repurchases. It will bring the nation's entire financial basis up to $550 million, an increase of $50 million. The money that a nation's people utilize on a daily basis makes up a large amount of MB. As a result, it sheds light on a country's nominal GDP, the economy's price level or level of inflation, as well as its short or long-term economic trends. As a result, it serves as a direction or point of reference when deciding on monetary policy. The Federal Reserve or central bank balances of depository institutions and cash in circulation outside of the Treasury and Federal Reserve make up the monetary base. It is a measurement of the money supply and is often referred to as base money, MB or M0. M1 and M2 are further metrics of the money supply. It provides information about a country's nominal GDP, the economy's price level or level of inflation, as well as its short or long-term economic trends. The Federal Reserve website lists the United States MB value as $6,413.2 billions of dollars in December 2021 and $6,103.5 billions of dollars in January 2022. An essential idea in monetary economics is shown by the definition of the monetary base. Every nation has a central bank that creates, regulates, and oversees the flow of currency. For instance, the US monetary base is managed by the Federal Reserve, which is a country's central bank. Open market operations or conventional monetary policy measures are used by central banks to regulate the MB. For instance, the US's MB value varies when the Federal Reserve buys and sells US Treasury bonds by acquiring Treasury securities as free market activities. Another illustration is that the Fed might cease the lending programs when it's time to lower the MB. Even though these characteristics are only a small portion of the enormous array of financial and economic data that policymakers evaluate, money supply indicators, including MB details, must be studied by a nation's monetary regulators in order to effectuate monetary policy. As M0, MB also represents a significant share of a country's money supply, it may also go by the names M0, money basis or base money. M1 and M2 are further metrics of the money supply. The amount of money in circulation overall includes transaction deposits at depository institutions. Savings deposits, small denomination time deposits, retail, money market, mutual fund, and shares are all added together to create M2, which is equal to M1. The entire value of the money in circulation and reserve balances is how the MB is represented numerically. In the formula above, MB stands for the monetary base, C for the currency in use, and R for the reserve balances. The total deposits made by all different types of depository institutions into their accounts at the Federal Reserve or the country's central bank are known as reserve balances. These are the fundamental input values needed for MB calculations, as well as the input for calculators that use the monetary base. The basic example that follows will help you comprehend the idea and how to use the formula. A nation's central bank has $70 million in bank deposits from banks and other depository institutions, out of the $300 million in its available currency. The nation's MB is $370 million in total. The formula is MB is equal to C plus R, or MB is equal to $300 million plus $70 million is equal to $370 million. Let's examine the monetary basis of the United States in a practical example. The MB numbers for December 2021 and January 2022 are as follows. MB is equal to C plus R. December 2021, MB is equal to 2,225.3 plus 4,187.9 is equal to 6,413.2 billions of dollars. In January 2022, MB is equal to 2,232.9 plus 3,870.5 is equal to 6,103.5 billions of dollars. Money supply refers to the total amount of currency in circulation as well as demand or checkable deposits when the MB includes both currency in circulation and reserve balances. Since reserve balances are excluded from the computation of the money supply, it is clear that the idea of money supply corresponds to the amount of money readily available for consumption. The total quantity of money that is visible in circulation throughout society and deposits made by depository institutions in the country's central bank constitute the monetary base. The Federal Reserve, for example, has the authority to manage the MB value in general. To keep MB at the desired level, they employ open market operations and monetary measures. MB is calculated using the formula MB is equal to C plus R, where C represents the total value of the currency in circulation and R represents the reserve balances. While the money supply refers to the quantity of money in circulation and demand or checkable deposits, MB is the total value of the currency in circulation including reserve balances. The distinction in its formula is that reserve balances are not taken into account when calculating the money supply, demonstrating that the money supply idea is more focused on the money that is readily available for usage. It is important to emphasize that the monetary base only accounts for a country's most liquid currency, or the total amount of money in the form of coins and banknotes that is immediately usable. While some of these coins and banknotes are in widespread use and retained by the general population, others are kept in the reserves of the central banks as bank deposits. given that the Federal Reserve can issue more money for general circulation or raise more money for bond purchases, a nation's monetary base may occasionally increase. Money supply captures a wider viewpoint, while the monetary base simply takes into account the most liquid form of a nation's currency, such as banknotes and coins. The whole monetary basis of a nation, including other assets in less liquid forms, is represented by the money supply. The money supply is divided into M0, M1, M2, M3, or M4 categories to properly reflect the range of assets. The lowest levels of the money supply contain information on the overall amount of money in the monetary base. Therefore, the difference between a country's monetary base and its money supply is that the former refers to the most liquid assets that may be used right away in a country, whereas the latter refers to all of that country's assets. Every nation's central bank is responsible for managing or supervising its monetary base. Given the peculiarities of the current economic environment, the central bank has a responsibility to either raise or decrease the monetary base. The central bank efficiently manages the monetary base through appropriate monetary policies. In many nations, the government can control the amount of the monetary base by using open market operations to buy and sell bonds. The total amount of money that is immediately usable in an economy is known as the monetary base. And that's it for this video, Fortune Fastlaner. Remember to subscribe to our channel, and if you feel like we have delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work you put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you will start to see results. See you soon.